Now let's look at some wild cards, namely Japan, China, and the emerging market, and more specifically, a subgroup of the emerging market. Starting with Japan, Japan has been in a deflationary, no-growth environment for the last 20 years. Recently, they've got a new Prime Minister Abe, and he has a three-arrow economic policy. Namely, it's fiscal policy, massive monetary easing, similar to what we've seen with the US quantitative easing, and the third one's structural reforms. He's implemented the first two. They're the easiest to do, and they've had limited success. I mean, I would say, moderately successful, but they're of a short-term duration. If you really want to get the US economy moving over the medium to long term, you need real structural reforms. The two that most people look at are labor reform and agricultural reform. And just to give you a flavor of the issue in Japan, these are some of the tariffs you see in Japan on agriculture. Rice, almost 800% tariff, butter, 360%, sugar, 305%. So definitely there's room to do some structural reform. Why is this important? Well, because if you look at this graph, which shows net debt to GDP in going out into the future, you can see that if you don't do anything, it's going to continue to go higher. And you need to actually do some aggressive reforms in order to get that line to turn down, like on the green line. Because Japan has a debt problem. Right now, net debt to GDP in Japan is 144%. Other than Greece, which I don't consider a developed world, it's the highest in the developed world. It's estimated that you need, in Japan, at least 3% GDP growth over the next 10 years in order to address that problem. They've done less than 1% over the last 10 years, and the IMF says that even if you have aggressive and ambitious reforms, you're still only going to get 2% growth. So structural reforms are absolutely necessary and crucial to Japan. The problem, though, like any other country, it's hard to get structural reforms passed in the market. People have their own self-interests, and it's very politically tough to get them passed. There may be an opportunity in Japan with the growing nationalism that we've seen. And in fact, you see in this chart, the percentage of Japanese who feel unfriendly towards China is 81%. Korea, not as much, but still high at 58%. If you're in Japan and you're worried about China taking over the region, what you need is a strong economy to counter that. And the hope would be that the Japanese people would put their own self-interests behind the good of the country and not have as much self-interest and hopefully let them get those structural reforms passed. So that's an opportunity, and a huge opportunity, because Japan being the world's third largest economy, if we could get growth out of Japan, that would be a positive for the whole global economy. Now, I just want to quickly point out, you see these numbers of what Japanese feel towards China and South Korea. It's a two-way street. In fact, the Chinese ambassador to Britain recently compared Japanese Prime Minister Abe to Harry Potter villain Voldemort. And in South Korea, the North Korean dictator Kim Jong-un is more popular than the Japanese Prime Minister. So again, a remarkable stat. Now let's have a look at China. And you can see from this graph, it's showing private sector debt as a percentage of GDP. And the red line is China. And you can see how dramatically higher that line has moved over a short period of time. In fact, it's higher than what you see in Europe. It's higher than what we see in the US. And it's actually higher than the peak we saw in the US before the financial crisis. What's even more worrisome about this growth is that it's happening. This is corporate debt. It's not household debt. There's very little household debt in China. Corporate debt, it's been rising at the same time GDP has been slowing. Last year, GDP only grew 7.7%, which to us would be huge. We'd love that. But in China, that's actually fairly slow, and it's projected to only grow 7.5% this year. Now, part of this is a plan. China needs to rebalance its economy. It has to move away from being an export economy, away from being dependent on investment, and move more towards consumption. As a percentage of GDP, consumption in China is only 35%. As a comparison, in the US, it's 70%. So China wants to make this shift. The only problem is that it's going to mean lower economic growth, and the concern would be that they make a policy mistake and you have a hard economic landing in the world's second largest economy. So again, that is a potential wild card if that were to play out in that way. Now, the last one, the emerging market, Goldman Sachs' Jim O'Neill coined the phrase BRICS, which is basically Brazil, Russia, India, China, and South Africa. Just recently, he added a few names to that, called them the MINTs, which is Mexico, Indonesia, Nigeria, and Turkey. It's a subgroup of this that is the problem, and what has been dubbed and coined the Fragile Five. Now, what do the Fragile Five have in common? Well, let's throw up a graph that shows currency movement versus current account deficit. Let's put on all of those countries and a couple more. You can see what the Fragile Five have in common is that they all had their currencies under pressure last year, and they all ran or run current account deficits. Now, current account deficit isn't a problem when you have the world's largest economy, the US, printing a boatload of money. Money is easy to get because these countries, because they have a current account deficit, they need money. They need money flowing into their markets. If you start to taper monetary policy in the US and that money becomes less easy to get and starts to flow back towards the US, then you have a problem. And then if you are one of these countries and you still need that capital, what you need to do to continue to attract capital is you have to raise interest rates. The problem with that is you're raising interest rates when your economies are weak, and it's a bad combination. And it's one of the reasons why the markets this year were a little bit more volatile, because it was a concern on what's going to happen to these economies. Now, I've listed off the Fragile Five, but one could argue, is there a Fragile Six? Because, oh, Canada, look who's on that list in the fragile zone. It's Canada. Our currency was under pressure last year, and we also run a current account deficit. Now, if we look at from a purchasing power parity point of view, and you look at the dollar versus the gray line is purchasing power parity, we're around 90 cents right now. Purchasing power parity is about 85 cents. To put this in everyday terms, The Economist magazine has put together a Big Mac index to show which countries' currencies are over or undervalued. If you look at a Big Mac in the US, it will cost $4.62 on average. In Canada, converted into US dollars, a Big Mac is $5.01. So again, you have about another 10% downside, potentially, you could go to reach that purchasing power parity. Now, it's very rare that the Canadian dollar actually trades at purchasing power parity. So, will it go there? Well, I think what's really impacted the dollar more than anything is the strength of the economy. And if you can see this graph, again, this is the Canadian dollar in red. You can see how it's been moving up. We went to parity and beyond, and recently has started to move lower. If we were to overlay that with this blue line, now the blue line is the US unemployment rate minus the Canadian unemployment rate. So when the blue line is moving up, it means the US unemployment rate is increasing faster than the Canadian rate. When you get up into that shaded zone, it means the US unemployment rate is higher than the Canadian one. And it's rare that that happens, but during this recovery, it actually did happen. We, Canada, recovered quicker than the US. Our unemployment rate recovered quicker than the US. But recently, as you see the blue line starts to move down, it's reversed. And what this means is that for most of the recovery, most people felt that the Bank of Canada would end up raising interest rates before the US. And now it's the reverse. The US is likely to raise interest rates before Canada because our economy has certainly not done as well as the US. So when we look forward, we would say that that we wouldn't see the Canadian dollar to continue to go down, because one of the things, the bigger impact on the Canadian economy is what happens in the US economy. So you can see from this graph, the red line is US GDP growth, and the black line is US leading indicators, or as a sign of what's going to happen in US economic growth. And you can see, again, a very tight correlation. They move in sync with each other. And so what this is telling you is that what really matters in Canada is what's going to happen in the US. And that's going to be the main driver of the Canadian economy. And it's one of the reasons why tonight we spent a lot of time talking about what we see happening in the US versus what we see in Canada. Now, one of the advantages also that could be a bit of a tailwind for our economic growth is the Canadian dollar. CIBC estimates that a 10% decline in the Canadian dollar adds about 40 basis points to our economic growth. A headwind, however, is going to be the housing market. And we don't see a housing market crash, but we do think a lot of the new homes that are being built, that the housing starts, will definitely decline. We're overbuilding. And if you look at the percentage of the Canadian labor force that is in the construction industry at 7.5%, that's very high. So this is going to be a headwind on economic growth.